The market is currently closed. Rezolve AI, trading under the ticker symbol RZLV on the Nasdaq, finished its last active session on Friday, May 15, 2026 at 4 p.m. Eastern Time at an exact closing price of $2.55 per share, marking a downward intraday move of 2.67% on the day. While a retail trader looking at a standard stock chart might see a small volatile tech player fluctuating under $3, the real institutional narrative developing behind the scenes points to an aggressive commercial land grab. While the broader public focuses heavily on dominant megacap tech holdings like Nvidia stock, Apple stock, or Tesla stock, microcap companies operating in highly specialized niches are securing massive corporate alliances that completely change their fundamental growth trajectory. Rezolve AI just completed a massive strategic maneuver by finalizing a global partnership with Tata Consultancy Services, a global technology titan with more than $30 billion in annual revenue. This arrangement means TCS will directly resell Rezolve's specialized software infrastructure to its enormous global enterprise client base and feature it inside their elite innovation hubs. For a company with a market cap sitting right around $1 billion, gaining the direct sales force and backing of a global consulting powerhouse is an extraordinary commercial milestone that completely alters how we must view its distribution scale. The general belief held by most casual market observers using retail investing sites is that small, newly public software companies are incredibly risky, highly dilutive cash burners that struggle to find real enterprise traction. People open their mainstream apps, look at a volatile chart, and assume that without massive direct marketing budgets, these businesses will simply fade away. The contrarian reality is that Rezolve AI is successfully bypassing the slow, expensive traditional sales cycle by embedding its platform directly into the product portfolios of global aggregators. When a massive services firm integrates your software into their core offerings, your customer acquisition cost drops drastically, while your potential market scale expands exponentially. Retail investors checking their individual brokerage balances frequently overlook these institutional distribution agreements, preferring to hunt for familiar large caps on online investing platforms, but the smart participants are watching this microcap setup with intense curiosity because the financial numbers are beginning to shift rapidly. To understand the intense tension around this specific equity, you have to look closely at the massive trading volumes and aggressive daily price swings we have witnessed over the last several trading sessions. During the middle of May, we saw daily trading volumes explode to over 34 million shares in a single session, a massive surge that indicates institutional accumulation and intense block trading activity rather than basic retail churning. These major volume spikes occurred precisely as the company confirmed its full-year financial guidance, reiterating an incredibly ambitious revenue target of $360 million. When you contrast a $360 million revenue projection against a total market valuation hovering around $1 billion, you quickly realize the market is pricing this asset with extreme skepticism, creating a massive discrepancy between what the company claims it will generate and what the public market is currently willing to pay for those cash flows. This sharp divergence between expectation and reality is exactly why we are seeing deep fragmentation in institutional valuation models. Traditional fundamental analysts running conservative discounted cash flow calculations look at the company's historical net losses and suggest that based on trailing figures, the intrinsic value is incredibly low, sometimes scraping the bottom of the barrel. Meanwhile, growth-focused institutional funds looking at the forward annual recurring revenue potential from the new distribution channels are setting internal price targets closer to $10 per share, arguing that the asset is deeply discounted. This massive tug-of-war is playing out across specialized trading desks, causing the immense implied volatility we see in the options market, where premium sellers are pricing in massive double-digit expected moves over the coming weeks. If you analyze the broader macroeconomic pressures, small-cap technology stocks have been fighting a brutal uphill battle against sticky interest rates and tightening credit conditions. When capital is expensive, institutional wealth management desks and large platforms like Fidelity Investments or Schwab Intelligent Portfolios naturally rotate client funds away from speculative software companies and move them into safe, high-yielding defensive assets or highly capitalized megacaps. This structural asset rotation explains why the stock has faced steady downward pressure over the longer time horizon, despite putting up massive sequential growth numbers. The immediate trading desk data shows that while short-term momentum has clearly ticked up following the recent enterprise announcements, long-term holders who bought during previous market cycles remain significantly underwater, which creates a steady supply of overhead resistance as the stock tries to climb back up. Let us step back for a moment and look at exactly what this business model is and how it actually generates revenue. Rezolve AI operates as an AI-native commerce infrastructure provider, focusing entirely on a concept known as agentic commerce. Instead of building basic chatbots that simply answer user questions with static text, they have created a proprietary engine known as BrainSuite.
This software platform is designed to plug directly into the digital infrastructure of massive retail corporations, enabling complex automated workflows. This includes conversational commerce, where an autonomous digital agent can guide a shopper through product discovery, instantly personalize promotional offers, and handle complex checkout processes entirely through natural language interactions. Their business model relies on a mix of high-margin annual recurring software licenses and transactional volume fees tied to the commerce passing through their platform. Looking back at their older financial disclosures, the company spent substantial capital building out this proprietary stack and establishing its initial market presence. For a long time, the bear case against the stock was that its technology was purely theoretical and lacked real-world enterprise validation. However, that specific narrative was completely challenged when the company dropped its first 4 quarters financial report, showing a staggering $60 million in revenue for the first 90 days of the year. To put that into perspective, that single quarter of performance managed to exceed the company's entire revenue generated during the full previous year. This explosive growth rate shows that their commercial engine is finally turning over, driven by aggressive expansion and unique moves like launching specialized commerce models inside major cloud ecosystems and expanding digital token utility across massive international digital banks. Comment below how many shares of Rezolve AI you currently hold in your portfolio right now, or if you are entirely avoiding the microcap software space in this current macroeconomic climate. It is vital to gauge where real retail interest sits versus institutional positioning. As we look toward the future, the primary catalyst to watch is the speed and execution of the partner rollouts. Gaining access to an enterprise client base through global tech consulting networks is an incredible advantage, but the revenue will only show up if those corporate clients actually adopt and deploy the software at scale. If the implementation pipeline moves quickly, the company could easily validate its steep full-year financial guidance, which would force mainstream institutional analysts to completely re-rate the stock, potentially triggering a massive short squeeze and an aggressive upward revaluation across major self-investing platforms and automated robo-advisors. Conversely, the risks here are entirely tied to execution and capital management. Fast-growing software companies that engage in aggressive corporate maneuvering can quickly burn through cash if their integration costs balloon, or if their acquired distribution channels fail to deliver active paying customers. There is also the persistent risk that larger, deeply capitalized legacy software providers could introduce competing agentic commerce features into their existing enterprise suites, neutralizing the competitive advantage of smaller niche players. This creates a high-stakes environment where the company must run incredibly fast to secure market share before the competitive window closes. When you look at the totality of the evidence, the central insight regarding Rezolve AI is defined by the stark contrast between its microcap valuation and its massive enterprise alliances. The general market expectation views this asset as a highly speculative, volatile tech stock that is subject to sharp daily swings and macroeconomic headwinds. The underlying reality, however, is that the business is rapidly building an enterprise-grade distribution network that is putting up unprecedented quarterly revenue growth. Whether this rapid operational acceleration can successfully close the massive gap between conservative discounted cash flow models and highly bullish forward revenue targets remains the ultimate question for investors navigating the current market. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.